Imagine a world where the money in your pocket, the digits in your bank account, are quietly, relentlessly losing their value. Not just a little bit, but fundamentally. This isn't a dystopian novel, it's the reality unfolding in global finance right now. A silent revolution, a mass exodus that we call the debasement trade. Rapid montage connects themes, no slowdown between sections. Welcome to Next Rise. Today, we're unpacking a crisis of confidence that's shaking the very foundations of our financial system. Why are smart investors ditching the world's most powerful currencies, the US dollar, the euro, the Japanese yen, and rushing into gold, silver, and even cryptocurrencies? The answer, as we'll discover, isn't just in today's headlines, but etched deep within the pages of history. The debasement trade describes a strategic move by investors. They're liquidating holdings in major fiat currencies and converting that wealth into hard, non-sovereign assets. This isn't just about chasing higher returns, it's fundamentally about wealth preservation. Investors are trying to shield their capital from what they perceive as the accelerating erosion of purchasing power in our modern paper money. Quick comparison: gold, silver, Bitcoin versus major FX. Prices rise as fiat power fades. Let's keep moving. The numbers are stark. In just the past year, gold has surged, hitting unprecedented highs north of $4,200 an ounce as of October 2025. Silver and Bitcoin have followed suit with significant gains. Meanwhile, the three titans of global finance, the dollar, the euro, the yen, have quietly but dramatically lost 40% to 55% of their purchasing power against these very same hard assets. This isn't a mere fluctuation, it's a systemic derating. But to understand why this is happening today, we need to understand how it's happened before. This isn't the first time the world has grappled with currency debasement. In fact, its origins are ancient. In eras when currency was metallic, gold and silver coins, a ruler couldn't just print more money. So when empires faced financial strain, often from perpetual wars or lavish spending, they resorted to a cunning but ultimately ruinous trick. They'd reduce the precious metal content of their coins. Empires expand, costs explode, debasement soon follows. Take the Roman Empire. Emperor Nero, desperate to fund his grand projects and stabilize the empire, began quietly lowering the silver purity of the denarius. His successors continued this trend. By the infamous crisis of the 3rd century, a period of relentless civil wars and economic turmoil, the silver content of the denarius had plummeted from over 90% to a mere 5%. The consequence? Hyperinflation, a collapse of trust, and the economy grinding to a halt. War, markets shuttered, trust collapses, value flees coins. Fast forward to 16th century England. King Henry VIII, plagued by incessant wars and the construction of his opulent palaces, faced a similar fiscal dilemma. His solution was the Great Debasement. He systematically reduced the silver content of English coins by an astonishing 70% between 1544 and 1551. The public quickly caught on as the cheaper base metals literally began to show through the silver plating, earning Henry the nickname Old Copper Nose. See Henry's coin, base metal peeking through. In both cases, the mechanism was simple and the outcome identical: rampant inflation, a loss of public trust in the currency, and a mass flight to actual gold and silver. People stopped accepting the debased coins at face value, hoarding real wealth instead. History provides a chilling preview of our present. Today, governments don't need to mix metals. The alchemy of modern debasement is achieved through two primary tools: unrestrained money printing and excessive borrowing. The underlying drivers, however, are precisely the same as in ancient Rome or Tudor England. Funding massive expenditures, often wars or social programs, that far exceed the state's capacity to finance through legitimate taxation. For decades, central banks have engaged in unprecedented quantitative easing, essentially creating vast sums of digital money to buy government bonds, artificially suppressing interest rates and stimulating economies. While initially hailed as a savior during crises, the long-term consequence has been a ballooning of money supply without a corresponding increase in real economic output. This, fundamentally, dilutes the value of every existing unit of currency. It's a stealth tax, eroding your savings without a vote in Parliament. When governments issue too much debt and central banks print money to monetize that debt, they are effectively devaluing the currency. Just as Henry VIII's shilling lost its silver, your dollar, euro, or yen, is losing its purchasing power. Old coin clipping mirrors today's balance sheet expansion. Now let's examine the specific vulnerabilities plaguing the world's three most influential currencies. First, the US dollar. Its recent weakness stems from a cocktail of factors. The trade wars initiated by President Donald Trump led to retaliatory tariffs, dampening global demand for American goods, and thus, the dollar. Political instability, like government shutdowns, further chipped away at investor confidence. And the looming specter of recession, driven by inflationary pressures and reduced consumer demand, forces the Federal Reserve to consider interest rate cuts, which typically weaken a currency. But the biggest blow to the dollar's long-term dominance might be its weaponization. The freezing of Russian central bank assets in 2022 served as a stark warning to other nations. Holding vast dollar reserves entails geopolitical risk. This act accelerated a global de-dollarization trend, pushing central banks worldwide to seek safety elsewhere. Then there's the euro. The eurozone's perennial challenge lies in its incomplete fiscal union. Recent political instability in France, with repeated government resignations and deadlocks, has raised alarm bells about its ability to manage its national debt. This directly triggers a sell-off in French government bonds by foreign investors, who then convert their euros into more secure assets like gold. The structural fragility of the eurozone, where national fiscal policies are not fully aligned, leaves the common currency vulnerable to crises in individual member states. And finally, the Japanese yen. Japan is grappling with perhaps the most daunting sovereign debt burden in the developed world, standing at a staggering 260% of GDP. The prospect of future leaders, like Ms. Sanae Takaichi, advocating for ultra-easy monetary policy, essentially more low interest rates and massive government spending, sends shivers down the spine of bondholders. This approach necessitates further money printing, ballooning the yen supply, and predictably, diluting its value. For an investor, it's a clear signal. The currency's value is being sacrificed for sovereign debt management. Japan's debt tower grows, confidence in yen shrinks. Yen supply multiplies, purchasing power thins fast. So, where are investors fleeing to? The answer lies in assets that are largely immune to government and central bank manipulation. Gold remains the ultimate safe haven. Its recent surge, reaching historic highs, is driven by multiple factors. It's a classic hedge against global economic slowdowns and recessions, providing stability when other assets falter. Crucially, central banks themselves are buying unprecedented amounts of physical gold, motivated by the dollar's weaponization. They are systematically reducing their dollar reserves and bringing gold into their own national vaults, valuing security and sovereignty over liquidity. Beyond central banks, private investors are also using gold to hedge against a potential bursting of the so-called AI stock bubble, the sky-high valuations of US technology stocks. In an overvalued equity market, gold acts as portfolio insurance. Silver often follows gold's trajectory, offering a similar hedge with added industrial demand. And then there's Bitcoin, the digital gold. Its allure lies in its fixed, immutable supply of 21 million units. Unlike fiat currency, Bitcoin cannot be debased by central bank printing presses. It offers programmatic certainty in an era of monetary uncertainty. The debasement trade isn't just a fleeting trend, it's a profound vote of no confidence in the prevailing monetary paradigm. History teaches us that when rulers, ancient or modern, resort to financing their excesses through currency debasement, whether by clipping coins or printing digital money, the market eventually reacts. Trust is eroded, and wealth flees to what is tangible and truly scarce. As economic analysts, our role is to observe, to connect the dots, and to learn from history. The current flight from fiat is a stark reminder that the stability of our financial future depends not just on economic growth, but on the integrity of the money itself. The question isn't whether paper money will disappear overnight. It's about its relative value, its purchasing power, and its reliability as a store of wealth in an increasingly uncertain world. As long as fiscal discipline remains elusive and central banks continue to grapple with the consequences of unprecedented monetary expansion, the shadow of debasement will loom large and the flight to hard assets will continue. What are your thoughts on the debasement trade? Do you believe governments will regain control, or is this a permanent shift? Let me know in the comments below. If you found this analysis valuable, please like this video, subscribe to Next Rise for more in-depth economic insights, and hit that notification bell. Thank you for watching.